And welcome into the Roundtable. Bill Priestley here with you. And the economic times have slowed down a bit here in the middle of 2023. And does that make the M&A space possibly even more attractive to some people at this point in time? Joining us to talk about it is Spencer Tenney, CEO and president of the Tenney Group, specializing in M&A access there as well. Spencer, thanks so much for joining us. As you look at it right now, here we are, middle of 2023. The economic indicators are not great for the rest of the year. How do you kind of measure right now what's going on in the M&A space? Granted, we had a big merger, or at least a big acquisition with Knight-Swift and U.S. Express earlier this year. Haven't seen as many on the large scale, but how do you measure the market right now?
It's a mixed bag. And I think it really has to do with the size of the transaction. As you mentioned, the Knight-Swift U.S. Express deal is kind of a little bit of an outlier based on what's happened in the last 6 months. But I will say activity for your smaller to mid-sized transportation logistics company has remained fairly steady. And it slowed down without question a little bit in the last 6 months. But here, just in the last, I would even say 30 days, we've seen tremendous momentum going into the second half. I think there's a lot of reasons for that.
Looking at that, well, let's just jump into some of those reasons. Looking at some of the economic indicators saying we may not see economic growth in the transportation industry for the next 6, 8 to 10 months. Does that make things a little bit more fertile for some people in terms of maybe even looking for an exit strategy, maybe looking to be acquired, maybe looking to expand?
Well, I think the factors that I think are going to influence a significant amount of activity are these. Going back to COVID, there was a huge supply of business owners that were at retirement age that didn't exit. And largely that was because the distraction of COVID, or because business got so good during that period, they just couldn't let go. And then now we kind of come into this period where for a lot of folks, they intended to exit again, but with the interest rates rising as quickly as they did, many folks thought that this might not be the best time to sell. I think what's happening right now is that interest rates are stabilizing, but all the other fundamentals that have been driving record level M&A for the last, call it 3 to 5 years, they're still the same. And so in order to grow, in order to differentiate, to capitalize on technology, people are going to have to take opportunities to grow via acquisition. So for the buyers, it's a favorable market in terms of potential valuation. Debt's expensive, and it makes it a little bit more challenging to get deals done. But I think what's helpful to that process is that the sellers over the last 6 to 12 months have had a little bit of an opportunity to kind of recover from that COVID hangover when valuation expectations got a little bit out of hand. So I think this is turning into the next 6 months of a very helpful environment for deals to get a meeting of the minds between buyers and sellers.
So given the criteria that you just mentioned there, is there sort of, and I know I'm generalizing here to a great degree, but a sort of profile of a business that might be better suited to start having those talks about M&A? Or is it simply, like you said, small to medium-sized businesses, possibly more affected, but not really of a certain ilk, if you will?
I think it really just comes down to, where the owner is in terms of age, goals, and just the life cycle of the business. Because what happens is they may not think it's the best time in the world, but if they know in their heart of hearts that they don't have the fuel in the tank to go combat, rising expenses across the board, then really effectively, the way they don't look at this as selling, they look at this as wealth preservation. Because if they don't exit, and they're not willing to do the things required to enhance business value, then effectively they're just forfeiting business value as part of delaying an exit from this industry. So I think that's really the decision is, I think that's why we've seen record numbers of first-time acquirers in this space, is because if you're not integrating acquisitions into your growth strategy in some way, it's just very hard to be competitive given all of the constraints in the marketplace, rising expenses, emerging technology, what have you. And so I think that's a lot of business owners facing the realities and trying to be good stewards of the value that they've created in their businesses.
As we entered COVID, and of course you had the stimulus money that created just a massive amount of freight that needed to be moved, and you had a lot of people entering into the freight marketplace trying to make a buck here and there. I can only assume, of course, that medium-sized businesses, small to medium-sized businesses, also made some investments in trying to get a chunk of that cash there as well. Now, as we're kind of on the back side of it, how much has that happened, just the economic downturn of coming off of this incredible high done in terms of the M&A space? You mentioned the last 3 to 5 years, there's been a lot of activity, but even looking in the last 6 months or so, as things continue to go, how much has COVID had an effect on, for lack of a better term, your business?
No, I think that we remain steady for a variety of different reasons. But I think one thing that I think is going to create, I think it's just obvious of what's happening in the market. COVID created a shortage of supply of equipment across the board. And so when a lot of small to mid-sized operators got their opportunity to purchase that equipment, they did so at extremely high rates. And so now you have a balance sheets that effectively were that. I was just interviewing from Taylor and Martin and talking about how just in the last 15 months, these equipment values have just plummeted. So you have balance sheets that are upside down and you have a soft freight market. There's a lot of folks that are going to get pinched. They can still be valuable to the right buyer. But I think what's going to happen for a lot of companies that kind of fit that profile is that they're going to be forced with some tough decisions over the next 6 months.
Yeah, exactly. That's right where I'm going here as well, because obviously, we talked with John Kingston, one of our writers, not too long ago, and one of the things he was surprised by here as we get to the midpoint here of 2023 is we haven't seen more bankruptcy stories that have come out, basically coming off of this economic downturn and things not being as fruitful on that end there as well. As you look at it, in terms of, when is the right time maybe to start having those conversations? Again, just looking at the criteria, if the owner is ready to do it, if the owner has the attitude to do it. Again, you're talking about wealth preservation there as well. When do you start having these conversations, knowing that perhaps there's not that economic uptick possibly coming in the next 6 to 8, 10 months?
I mean, I think just as a discipline, our general philosophy is that you should always be looking at the business as something that is always for sale. So you always should be looking at what are your options on any given day. And I think that as you look back to like 2019 was probably the highest spike in bankruptcies in our industry in the recent future. And you can look at what happened. Like so many of those folks just waited way too long before they actually sought help to understand what their options are. And to be fair, like when you have the types of changes in the marketplace that we have right now, the cash flow problems snowball very fast. And so I think that my encouragement is every owner has many more options than they realize, but they can't sit on their hands. They have to be proactive and to reach out to folks who can actually affect that.
Do you think that's going to be the same case now as the second, again, if prognosticators hold true and we don't have much economic growth, do you think that we'll see that again, that people will simply hold on too long?
I mean, history says that that's probably the case. It's just human nature. We resist any type of major change. I hope that that's not going to happen. But the challenges are very real. And so I think my encouragement is just be humble and respect what's in front of you and go talk to as many people as you can around transactions, around reorganization, around just to find out what you can do to protect your business, the people, everyone associated, and your customers as well.
Let's talk about it from the other side of the spectrum in terms of the buyer perhaps looking to make a big splash or make a big investment and try and move their company forward and get a jump start on this on the economics when they start to turn and upward in that direction. If you're on that side of the fence and looking to perhaps acquire or merge and expand in that way, what kind of conversations are you having? And obviously it's you could go after anybody, I guess, but it's got to be a very specific kind of merger or acquisition that you're looking at.
I think that what we've seen kind of crystallize over the last 6 months with a lot of your major players that look to acquire in this space is just much more discipline in the profiles that they want to pursue, and even we're seeing some of the same acquirers divesting of verticals that within a diversified transportation group that aren't high performers. And so I think that if you're going to go acquire, you need to kind of cut the fat first to make sure that you have you're setting yourself up to be successful with something that's going to be a good platform type investment. And I think that there's all kinds of, there's tremendous interest. I think the access to capital is a question. We're going to see that affect the profiles the most is for folks like on the asset light side of things. If there's no way to collateralize that type of investment, it's going to affect valuation and structure. So I think what you're going to see in the 6 months ahead is that really aggressive plays by strategic buyers, niche operations that can get done by size and shape. And that's where they're going to put their energy around it. There's no really capacity to go invest, in some cases, millions of dollars of diligence around a deal that may or may not get done or may not provide the impact of what's required.
Looking at one other area, just back on the other side of the fence, looking at acquirees, we had a story that ran several months ago about a startup that had basically just announced to the world that they were 1 year away from running out of cash. And someone said, well, that seems to be, rather desperate. And someone else said, that seems like a cry for an acquisition or somebody to come in and buy them. If you're in a situation like that, if you are looking at, say, I want to be acquired, and maybe you're a startup that has had some venture capital investment and you've got some promise, but you just don't have the funding, how would you go about trying to make yourself available to a possible merger or acquisition?
Yeah, I think that the way that we do seminars about this, Bill, and I think that the folks that tend to create the most results fastest is that they mobilize the kind of centers of influence that have a vested interest in their success. And so for some, that might be, your tech people, of course, your M&A advisors, your consultants. These are people that have an interest in your success. Insurance solution providers. If you're going to be selling anyways, I guarantee you that insurance solution provider wants to at least have a chance to make the case about why they should maintain that insurance business as the buyer acquires that company. So I think this mobilizing those relationships and helping them understand what your goals are helps, exponentially multiply the quality at bats that you might have to have a meeting of the minds and get a deal done.
Last question, real quick. I'm looking in your crystal ball over the course of the next 6 months or so. Do you see M&A activity accelerating over the course of that time, or staying still, or maybe even dropping off?
100% acceleration. Just for context, in the next 3 weeks, we have 3 deals closing. One of those a 9-figure deal. So it's like we're extremely active, and I think that again, it just goes back to for buyers and sellers to get deals done. There has to be trust. And what we're seeing right now is they're not great interest rates, but we're stabilizing. And that's what we need for buyers and sellers to be proactively leaning in and getting deals done. So I'm very bullish that we're going to see a lot of fireworks in the second half of 2023.
Going to be a very interesting second half there as well. Spencer Tenney, CEO of the Tenney Group, thanks so much for joining us.
You bet.